The broadcast is now starting. You are in listen-only mode.
Hello, everyone, and happy 2018. We hope it's a great year for you guys, and thank you so much for starting it in the Darwinian webinar, so to say. If somebody can confirm quickly that audio and video is okay, we will get going. Hello, hello. Okay, perfect. Thanks, Steve. So let's get going. As ever, I've got a bit of a flow that I'll announce ahead of the webinar. If you have any questions that are within the remit of what we just covered, please, by all means, go ahead and ask them in the question box. If I feel that they're going to be answered later, or it's probably best for the Q&A session later, I'll just ask you guys to hold off because this webinar will be recorded. Furthermore, you've got a copy of the presentation that we'll discuss today as a handout to the webinar that you can download anytime you want. And generally, any feedback is more than welcome. So without further ado, today we're going to talk about DWC, which is a special breed of Darwin in that it is the first Darwin that leverages community data from the Darwinian community to create a trading strategy. And my core goal today is to explain how DWC came about and why it's also listed as an investment strategy available for Darwinian customers. Okay. Of course, at the end of this, we'll go through any questions that you might have. So don't feel shy in asking or suggesting or even questioning any of what I say. I will assume, however, that you do know a bit about DWC already. So because we have written quite extensively about it. So if you feel as though you want to have some more background about it, you can go to our YouTube channel where this webinar will also be uploaded and search for DWC Real-Time Sentiment Index on Security, and also the effects of market volatility on trader performance, which are both related to DWC, as well as you can also read on our blog in relationship to how to hedge your Darwin portfolio risk with DWC and understand the basis that makes DWC interesting in the first place, which is called, it's a psychological bias that every human has that is called loss aversion. Okay, so that's where you'll find more background on DWC. If you have any specific questions on it, don't be shy. I'll try and refer to the points that are made here as we go through the presentation. So as I mentioned, two topics for today. So first one is, why does Darwinex offer DWC, the index? Okay, well, the core reason we do is that over-levered traders exhibit loss aversion. And if you're not really sure about what loss aversion means, you can read about it, but we're going to do a bit of a thought experiment today. So let's say you guys have had a bit of an accident in traffic, and you actually ran over somebody, and that somebody, you think you've got a shot at settling outside of court by offering him a payout. Okay, and that payout is that you've got a 95% chance of losing in court, in which case this is going to cost you 1,000 euros. And you've got a 5% chance of actually winning, in which case you'll have to pay nothing to the other party. Now, you go ahead and tell your lawyer to offer the other party 900 euros to settle before going in front of the judge. So what do you guys think the other party will do? Will they take the 900 euros that you're offering, or will they not? And don't worry, guys, there's a bit of a trick question in here. So I repeat the experiment. 95% chance of paying 1,000, 5% chance of not paying anything, and you've offered 900 euros and then you call it quits. So should the other party take it? Yes or no? So I've got Raymond saying who's saying they'll take it, and Steve saying they'll go to court. And you know what? Both of you guys are right. It really depends on how desperate the other party is for the 900 euros. And let me explain. So I'll go with Steve. So for this initial offer, if the other party is rational, they will go to court. Why? Well, because I've offered them 1,000 euros, 900 euros for something whose expected value is 1,000 times 95%, which means 950. So I'm basically skimping here on what I've offered. I've only offered 900 euros for something which is worth to a rational other party 950. So if they are rational, they will go to court. However, and this is the trick about loss aversion, if instead of 1,000 euros, the claim at hand was, say, 10 billion, and I offered 9 billion, then I'm siding with Raymond here. I'm saying, okay, if I offer somebody who's basically not a billionaire, who earns in the thousands or tens of thousands of euros per year, the option of taking 100% certain payout of 9 billion, they will very likely take it, even if the value of the claim was 95% times 10 billion, 9.5 billion. And the reason is that the sheer thought of thinking that you could have had 9 billion and you played smart and you lost it is likely to basically damn you for the rest of your life. Okay, I'll let that sink in because that's a very powerful thing. It's actually something that drives, say, the insurance industry, for instance. The insurance industry, if you look at what you'll pay as an average driver for car insurance throughout your life as a driver, very likely the amount of the premium you'll pay your insurer far exceeds the amount of claims you'll take from the insurer. It's just that the thought of thinking, oh, crap, basically I've had a car accident and I can't afford to repair my car, makes you far more likely to take out insurance for a higher premium than you would expect to pay out of pocket if you simply just paid up whenever you had an accident. Okay, and this is a psychological phenomenon. If you want to read up on that, I have a book that I can recommend. It's called Thinking Fast and Slow by Daniel Kahneman. We refer to it in the blog, so if you want to save the book, you simply go to The House Always Wins Loss Aversion, where we explain this in a bit of more detail. But it's actually, so Steve is asking, it all depends on your perception of value, and the answer is totally. So when the value is small enough, you behave as a rational being, as a calculator, as a risk-neutral being. When the value is too high for you to fathom, and that too high is a subjective value, then at that point, that's when you become irrational and you become loss averse. When it comes to stock markets, what happens is the loss aversion is another way of talking about the old adage of the retail traders hang on to their losers and cut short their winners. Okay, so if you're a loss averse guy, as a trader, what you'll do is you'll cut your winners far earlier than you cut losers of the same size. Okay, which means you're going to lose systematically. And I've got, found this thing on Google of guy who basically will probably kind of hang on here and then will hang on to this loss because it's like, okay, if I cut my loss now, it's going to be a disaster. So that's loss aversion in a nutshell. And this is far from a theoretical thing. This has practical implications. So what you've got here is a slide by a very interesting study done by the Autorité des Marchés Français, which is the French FCA, which took a large enough sample of CFD traders and basically found out what most of you already know, is that the majority of traders lose. And of course, you would expect that because as you trade the markets, you're basically either paying the spread and or commissions, which means even if you were a random monkey, you would end up losing because you're losing just the transaction costs. What really baffled me here was, okay, what percentage of trader losses do you guys think is accounted for by transaction costs? So would you say it's what, 80% of loss is transaction costs, 60% of loss? What do you guys think is a number? If somebody can read French, they've already figured that out. Okay, so Ray's saying 50%, at least 50% of what customers lose is transaction costs. Okay, Steve knows French. Anybody else? Okay, so Alexander's saying it's probably very high, but trading slower charts will get this number down. Of course, if the less you rotate, the slower you eat into your capital from transaction costs. But actually, that's what I would have said. But the Steve is right. The number, and this to me was shocking, is 15%. Okay, I'm not saying the exact number is 15% because I'm not really familiar with how the French authority did numbers and so on. But actually, it's peanuts in the bigger scheme of things. So out of every €5 that or dollars a pound that retail traders lose, only one is lost to transaction costs. The rest is going somewhere else. Okay, and that's just to me, that's a big insight, and it has a lot to do with what we'll be discussing today. So it's a very, very small number. And it means if you think of it in the opposite way, if you want to make money from retail traders, it's a bad idea to try and just make it from the transaction costs, because that's what I said, 85% of the money is not going into transaction costs in the first place. Okay, and we're now getting somewhere. Okay, now this chart is by a publicly listed broker dealer that has a very, very interesting statistic, and I'll explain what this chart shows. Okay, so what you've got here is the revenue that they've booked from customers in the middle. So that's according to the broker dealer business model. But they also highlight how much money they would have made from the same customers if instead of being a broker dealer who selectively market makes some of the exposure, if instead of that they had fully hedged all client trades against the market. In other words, if there had been a pure broker that does not market make, the revenues are shown at the lower end here. Okay, so this number of sort of 31. So if instead of being a broker dealer, that I'll come back to in a second, they had been a pure broker, which is what Darwinian is, so they would have made, sorry, apologies for that. Instead of, they made far more by being a broker dealer, which is in the region of something like 45, 46, than they would have done if they had been a pure broker. In other words, they had at least 50% more margin by internalizing some of the spread. They would have had even more margin instead of being a hybrid broker dealer that makes markets part of the time and hedges part of the time. And if they had made markets against customers all the time, they could have essentially pretty much doubled their revenues, as you can see here. So if you were a pure betting house, just taking the other side of client positions, they would have made 60. If they had just hedged all against the market the way Darwinian does as a much principal broker, they would have made 30, and by selectively hedging when they have too much risk, they made something like 45. Interestingly, what you see here is that the two lines, so the top line and the middle line, run pretty much in parallel, but the other one runs lower. So the difference between both is what it costs a dealer to insure against extreme market movements in order to have big market movements not kill the shareholder capital. Okay, am I sort of managing to bring the point across? What I'm saying here is if you're a broker and you just make money from the transaction costs, then you make this much. If in addition to being a broker and charging for the transaction cost, you choose to take the other side of customer trades, then you benefit from that 80% of money which is not going into transaction costs that retail traders lose. And in other words, you become a market maker, which is about twice as profitable as just taking the commissions. Okay, so if you put 2 and 2 together, what this is basically telling you is it sort of pays to take the other side of a trade when there's an over-levered, loss-averse retail trader there? Okay, I'll let that sink in because that's kind of, it sounds a bit abstract, but does that make sense? So basically we're saying, because 80% of what people lose is not going into transaction costs, it pays to systematically do the opposite of what said people do, because if you do that, then you will get to pocket that 80% of losses that is not going into the transaction costs. And if you wanted to basically verify if that's true, you need go no further than the public accounts of a listed broker dealer, which is telling us as much. It's telling us if instead of taking the other side of customers, we actually hedged everything the way Darwinics does, we would make half as much as we make. Because we're somewhere in between, we actually make a bit less. We are basically paying for the insurance policy because our shareholders don't want to take the risk that our customers are very heavily piled in and right in a position, as a result of which we could lose our shirts or go bankrupt. The house would break. Okay, so everybody still with me? Okay, good stuff. I just wanted to make sure. I mean, sorry that I keep asking, because if we're lost on this one, then we're lost on the rest of the presentation. So okay, so Steve is saying, yes, if you're the broker, you can see all the market and you can go against it. Okay, actually, I'm going to be a bit anal on terminology. So a broker does not go against customers. The broker just collects the commission and sends the trade against the rest of the market. So Darwinics is a pure broker in the sense that we act as an agent that gets you on a bet, say, against Goldman Sachs. The way it works is that Steve goes long Eurodollar against Darwinics. Darwinics goes short Eurodollar against Steve. Then at the same time, Darwinics goes long Eurodollar against Goldman Sachs, which de facto means a convoluted way to get Steve long the Eurodollar against Goldman Sachs, and Steve pays Darwinics for arranging this bet. But Darwinics is not party to this bet because we are a broker. If we were a dealer or a market maker, then what would happen is that Steve would go long the Eurodollar against Darwinics, which would go short the Eurodollar. But that would make Darwinics a dealer, not a broker. Okay, so in this case, it becomes a two-sided bet where one guy's loss is the other guy's win and vice versa. And that's the core difference, because if I am a broker, all I'm doing is I'm collecting a commission, 15% of the money, and then my customers on average will pay 15% of what they lose to me via commissions and 85% of what they lose to the market. Okay, so and the market maker is a dealer, correct? Okay, so now we're all on the same page, and it's important that we have this broker versus dealer, right? Because otherwise this can lead to misunderstandings. In practice, most so-called retail brokers are actually broker dealers in the sense that they do both. But actually, most of the time, as you can see here, they're doing dealing. Otherwise, there wouldn't be such a big difference between both these two. All right. Okay, so let's get going. Now, from our standpoint, that is an issue because that means we have, for one and the same customer base, our competitors are making more money than Darwinics. And unfortunately, that's a problem because a lot of people ask us, hang on, so if Darwinics is so good, how come not more people know about it? And the answer is, well, whether or not we're so good, that's for the market to decide. But the fact is, because we make less money per customer, we can invest less money to acquire new customers than the competition. As a curiosity, I mean, how much do you guys think that a typical dealer spends in advertising on a customer before said customer places his first trade with him? Hint, hint, you've got the number right in front of you. Okay, so how much do I have to pay in advertising expense to get one customer and one new customer in the door? So he places, okay, so £1,200. I mean, that's just the number is, I mean, now I'm used to the sector, but like 3-4 years ago when I first came into it, it was mind boggling. So the likes of, the big household names that you all know about that are doing the advertising, they're spending 1,200 and more pounds to get one guy to the first trade. So, and unfortunately, because they're making twice as much as we do, that basically means we could spend something like at best £600 to get a customer in the door, and because we can't spend more than that, we can't advertise, and that's why not so many people know about Darwinics. We have to grow through word of mouth, and by keeping the customers in-house a lot longer. That's the other way to make this one work. Okay, but if you put two and two together, for us as a business, we need to resort to alternative strategies to make money. Of course, we could become a dealer, but that's something that's out of the question of our vision, because we just don't feel we would be credible in offering investing in Darwin's if we were pocketing monies when people lose. So we will never become a dealer. We will always be a broker, and we'll have to find ways to outbid the competition. Now, in terms of risks from our standpoint, and now we're getting to the point of why we offer DWC, there are essentially three risks that a broker or broker-dealer faces, but we face them to different degrees. So if we think of a dealer, of a pure market maker's only risk is market risk, the risk that all the customers are right, and the house is caught on the wrong side of the trade and it's basically out of capital. So that's kind of the risk for a market maker. In terms of business risk, when there are big market moves, it's true that about, say, 50% of the customer base, which is on the wrong side of the trade, is going to be wiped out. But their benefit is that they'll make all those guys' money and they can reinvest that into advertising to get new guys in the door. So market risk and business risk in their case offset each other. It's bad for them to have too big movements because they kill about 50% of the customer base, the ones that are on the wrong side of the trade, but because they make money from it, they can reinvest and reacquire new customers. They don't have any counterparty risk because, once the customer's deposit is gone, there's no negative balance that they have to chase in any way. From our standpoint, as a pure broker or a match principal broker, we don't have a market risk. As I mentioned before, in the case of Steve against Goldman Sachs, we don't necessarily care firsthand if it's Steve or Goldman Sachs who wins. We just fetch our commission and then we're done. That's a first order effect. As a second order effect, we very much want Steve to win because Steve pays us commission and Goldman Sachs doesn't. So if Steve loses all his funds, then we will have to get a new customer in the door. But unfortunately, catch, we don't make enough money to be able to advertise to catch new customers. So for us, whichever customers we lose are very, very painfully lost, and it will take a long time to get them back. Not only that, but it could be, as happened in the case of FXCM and, say, the Swiss market event in 2015, some of the customers may lose more than they had in margin with us in the first place. So it could be that if somebody is levered, say, 30-1, and there's a 5% movement in the underlying before the stop losses can trigger, which is more or less what happened in the Swiss franc event, then not only has the customer lost all the money that he had, actually he has lost money that he didn't have because we owe that money to our counterparty. We owe that money to Goldman Sachs, and we have to pay that out of our own pocket or go bust. Okay, so the risks here are quite different, and we need a way to hedge ourselves against the business and the counterparty risk of offered levered trading to people who lose more in losses than they pay us in commissions. Okay, that's basically the rationale for us to offer DWC, for us to use DWC. And actually, we developed DWC, which essentially replicates what a dealer would do. So whenever all our customers go one way, DWC as a hedging tool goes the other way, so that if for whatever reason there's a large, deep market move that kills a lot of our customers, then whoever is investing in DWC, including us, makes back some of those losses so we can reinvest into growing the business back again. Okay, so for us, DWC is a hedge against business and counterparty risk. Now, because of our vision, because DWC leverages community data, that data is the intellectual property of someone, in this case, the entire Darwinics community. So we do not feel we feel it's against our vision for us to leverage that data without offering the opportunity of leveraging that data to all its owners, which is our community. And also, we feel it would be unfair if DWC did not collect a 20% success fee, because that would basically create some sort of unfair competition against all the other individual Darwins. So that's the reason why we offer DWC for everyone to use as a hedge, the way we use it. And also the reason we collect the 20% success fee and pay it out as a dividend. Okay, so that's pretty much the reason we invented DWC. We actively use it at present. We invest a substantial portion of our balance sheet to hedge the risk that there is a big sweep that kills a lot of customers with or without negative balance. Now, as we've done that, we've seen that it's kind of quite interesting to use as a trading tool itself, and we've actually taken to trade it. And the jury is still out on whether it's a tradable asset, but it's we're trying to find some ways out of it. So I've got a couple of questions here, which I'll read and then try and answer. So Alexander is asking, so which of these types broker dealers are the ones that are the most exposed when things happen in the market, such as the sudden Swiss franc crash? Well, the ones that are really exposed are the pure brokers. So if you have a broker and you're offering a lot of leverage, then you face the risk of the market going against your customers before you can close out their trades because there's no market, in which case your balance sheet is further at risk. So big moves are worst for brokers. And that's why we control our leverage quite tightly in order to avoid those events. So, and Raymond is asking, is there no minimum equity before closing the accounts? And the answer is, in normal market conditions, there's no problem with the minimum equity, because as long as there's a price, the stop loss gets triggered and the customer gets closed out, and that's the end of the story. However, during the big flash crashes, what happens is that there's a gap. You can trade at, say, 120, and the next price at which you can trade is at 1. And you've basically eaten, your customers and you have eaten the 16 or 17% drop between one and the next second. Okay, so that's the risk. That's the negative balance situation risk. And because we think that risk is there, we invented DWC to hedge our own exposure. So if a lot of our customers, and that's essentially how a DWC works, whenever lots of our customers are trading in the same way, then as a precautionary measure, we take the other side of the trade, and so that we stand to win whatever our customers have lost, so that we can reinvest in customers. So Modestus is asking us, what is leverage on Darwinics? And the answer is, if you've got a 500 euro account, then it's up to 100 to 1, because it's tiny amounts. But the larger your accounts, we will contact you individually to reduce leverage. So we have very much in mind the risk that leverage poses to us, and we control this actively. If you want to, Modestus is asking me what sort of leverage we offer, and this is public on our execution conditions. So I'll just go out to the site, and you can look it out on Darwinics execution conditions. And this is updated at all times. So assets and spreads, and you can see the margin. So in this case, in some assets it's 1 to 100, in others is 1 to 30, and so on and so forth. But importantly, the larger your account, we will also limit your net open position so that actually de facto for larger accounts, the leverage we offer is less than this. And Tim is asking me, so you are not a marketing maker? And the answer is no, we are not a market maker. We are a pure broker. We never take the other side of a customer's trade. Okay, so any questions? Okay, so Alejandro has a very good question, which is the trades we place in DWC, we place in the open market, so we lose the spread. Okay, so we never trade against customers. What we do is when too many of our customers are, say, long the euro dollar, then we will basically take the opposite of that position, paying the market spread to hedge ourselves at a cost to us. Because by regulation and by vision, we never trade against customers. I hope that's clear. Okay, now, as you can see here, the game we play is to say, okay, we have a very, very different business model to everyone else. We have, because of the vision, chosen never to trade against customers. That is bad for us in the sense that the most we can afford to pay to advertise for customers is whatever brokerage revenues we make, which is the red bar in here. But then we've got something going for us, which is the fact that customers believe that it's better when your broker trades with you as opposed to against you. And also it's good in the sense that we can publish the value of the data. So for instance, one way to tell that we're not a market maker is to realize that a market maker would never publicly offer an instrument like DWC, because that would amount to letting the world know what his shareholders are doing. In our case, what we do is we let every one of our customers know what every other customer is doing in exchange for a 20% success fee whenever that information results in a profit. But the beauty in this is that customers are collaborating and sharing information with us in a way that is not possible with a dealer, because a dealer has an inherent conflict of interest between the interests of its shareholders, who benefit when customers lose, and the interest of customers, who obviously lose when they lose. Okay, so, and in a nutshell, we think that's going to result in a very interesting network effect, whereby because we reward the best traders with 20% success fee, they will come to Darwinics to feed their strategies. As a matter of fact, you may or may not know that several of the best signal providers on the likes of MyFX Book have shut down their offering of signals in either MyFX Book or MQL5 and have migrated all their strategies onto Darwinics. Okay, so the best traders choose to publish the strategies with a broker that protects their intellectual property and rewards it. And also because everybody wants to be like the rest of the best traders. So, I mean, you can see here, the numbers are growing. So let's just have a quick look. I mean, you can basically see for yourself the assets under management that are backing each trader. So you can already tell. So, THA, let's just look at the top guy. He's got 3.3 or 3.2 million AUM. The last year, okay, there's the effect of divergence, but because he collects a 20% success fee on 80% of profits, that's 16% of the total amount. If he repeats the same performance in 2018 that he delivered in 2017, 16% of 3 million is give or take $500,000 for trading his own account. Okay, and this is our best bet, basically to tell everybody, hang on, instead of taking leverage, just come to Darwinics, charge 20% success fee from investors, and there's guys who are already pulling $500,000 a year. And hopefully, you're going to be the next one. All right, so is that Understood. So that's kind of our USP, is we sell the intellectual property for a 20% success fee on behalf of the traders under our regulatory umbrella, and that is something that a dealer will never be able to do because it would come at the expense of its shareholders. All right, so there we go. So that's that. Now, when it comes to what could DWC offer you, well, in a nutshell, it's doing something that you can only do by either being a market maker or being a shareholder in a market maker, which is to trade against people who lose systematically, as we discussed before. So if you want to earn that 85% of losses, then you can basically either become a market maker, or you can buy shares in a market maker. But unfortunately, if you buy shares in a market maker, you'll have to pay the PE ratio for that. So let's just, if we go for plus 500 share price, which is insanely high. Let's just go for the last 5 years. So, and the P ratio is 10 or 11 to 1. So, if you want to become a shareholder in one of these market makers, you're going to pay a price earnings ratio of 11 times profits, at which point maybe that staggering amount of systematic wins is not going to be so high. Now, you can do something close to that by being a trader who's taking DWC. Now, as I mentioned to Alejandro, the disadvantage of DWC is that you are actually paying the spread. So as long as the market moves in a certain small range, you're not going to benefit quite as much as the market makers will do, because you're losing the spread to hedge the costs. But, and this is the moment when it gets interesting, if there are big market moves, then you can actually benefit from that, because you will profit when you are on the other side of a loss averse trade. As a matter of fact, you can see, and you go to DWC. Can everybody see my screen? Okay, so what I've got here is the loss aversion of DWC, which is showing you the maximum favorable and adverse excursions. Okay, so let's say, as an example here, this is one of the trades that DWC took in the euro dollar. It had a maximum profit in the trade of 4.77% of the equity. The most it got to lose was 0.05% of the equity, and it was closed, which is this black bar here, at 3.44. Now, what can you guys say about this strategy? And this is the reason why it's got a good loss aversion grade. Well, the green bars tend to be far higher than the red bars. And actually, when you catch one of these green bars basically outdoes 30 or 40 of the small red bars when you catch one. Right? So it's basically the opposite of retail traders. Whenever it wins big, and it tends to lose smaller than it wins, which is the way that the dealers make their profits. And by investing in DWC, you basically get the benefit of both things. So, if you happen to be loss averse yourself, and you happen to be trading with the bulk of the community when the community gets it wrong, then you can insure yourself by buying an instrument like DWC, which does the opposite of the community when the community goes the wrong way. And the other one is, if you get this one right and the timing right, then it could be that you could actually basically make big. So Steve is asking me here, how often is it revamped? And the answer is, it's a compromise between revamping as often as necessary, but also minimizing the transaction costs in it. So I encourage you, Steve, to read on the blog on how DWC is made. What it does is, most of the time, all of Darwinian's customers tend to be randomly on either side of the spread, say of the euro dollar. So half of them are long, half of them are short. There are times when for whatever reasons, because they're actually loss averse or because there's herd behavior that kicks in, then most of the community tends to be on one side of the trade for say, the euro. Now, typically, 50% of the time they get it right and 50% they get it wrong, but whenever they get it right, they make quite little, and whenever they get it wrong, they lose quite a bit, which is the way of looking at the asymmetry of the green bars being taller than the red bars here. And in that moment, you really don't want to be on the wrong side of the trade. Okay, so there's a question here by Eric, which is quite interesting. He's asking, are Darwinex Labs investments in our Darwins related to DWC? So Darwinex Labs has a mandate, which is to optimize the risk return profile of Darwinex's balance sheet. Now, the way to optimize our risk reward profile is, on the one hand, to invest in the best traders, as you would expect, but also, on the other hand, to hedge any downside risks whenever the best traders tend to get it wrong. So you will see that, and actually you can see on the performance fees, there's both, we've changed this now. Okay, if any of you guys was familiar with this, up to recently, we had in real time the amount invested by every user in the DWC. Now you see we've removed that because some users rightly complained that it was unfair. We were disclosing the trading strategy without collecting a 20 success fee. But you could see some users in here, which is, hang on, I'm going to find it now. Investing. On DWC investing, there's 2 users. Yeah, for some reason I can't really get to my Chrome to find it, but if it's one is called DWX Investing and the other one is Investing Robots, and those are that's Darwinex using the community hedge, paying 20% success fee like everyone else to hedge itself. So Eric, in answer to your question, is DWC is one side of the coin, hedging. The other side of the coin is investing for profit, which we also do with DWC. Okay, so as an example of what happens, I mean, we've got an example of what happened in the euro dollar with the committee between the 16th of April 2017 and the 16th of May 2017. And you can also see what the DWC did in that period. So let's just look at, we said 16th April. Which is roughly here, okay? So here we see it that month. So there you see it, okay? So what happened here is that this is the evolution of DWC in that month. And this is what triggered it, so you understand how it works. So we saw you had a deep movement in the euro dollar, which exited. It had been trading in a range for a while, and then it basically broke that thing and went from 106 to 111. And you saw that the community was asymmetrically one way. So 0.5 would be 50% of the community is one way and 50% of the community is the other way. You can see here that actually the community was the wrong way, and the more the euro dollar went against them, the more asymmetric that went, because some guys were trying to actively add against it and also were hanging on to the positions for quite a bit longer. As a result of that, the DWC made 15% in a month. And I don't have access to the data for broker dealers because they haven't really published that period yet, but I bet you guys they made a killing in the euro dollar trading against customers in that month. Okay, so I mean, hopefully that highlights the use of DWC. You can essentially proxy the behavior of a dealer, which means you can hedge your own exposure because very likely you have your own loss aversion, and also you just actively benefit from it without having to become a shareholder in a listed dealer, which carries a P/E ratio of 11 or more. And the other benefit of it, in addition to the hedging, is that we think it can it can potentially be traded for profit. Now, what you've got here is 3 curves. The first one is a measure of market volatility. The second one is the listing quote of the DWC in a certain period. And the last one, actually, the period is here from probably something like October 16 to June 2017. And also the green one is the number of open trades. So this is another point that I think Steve made before. It's like, how often does the thing rebalance? Well, it rebalances whenever more and more people pile in a certain direction. So a lot of open trades here means that the Darwinics community is very strongly positioned in a certain direction, and DWC is therefore strongly positioned against it as a hedge for us, for our and for the community's benefit. So if any of you guys is fancying a trading strategy built on it, we think, I mean, we don't know yet, but we think these are the 3 core variables you need to take into account. Okay, the volatility of the market, which you can observe outside, the quote of the DWC, which you can observe publicly on the Darwinics website, and also the number of open trades, which you can see in the underlying strategy. The number of open trades is the 3rd scale here, so the one that has comfortably open trades in it. And what we typically see is that an increase in the number of open trades tends to predate, at least it has in the backtesting data, any swings in the market. That's probably a good buying point. It also tends to predate an increase in market volatility. Now, as a caveat of this, obviously we have to highlight the fact that Darwinics has only existed as a broker since May 2014, and we're growing quite a bit, but for the first year and a half we were quite a small broker, so we don't really have access to a very large sample of customers. The volatility in this period seems to have been roughly constant, but if you put that volatility into context, as you can see right now, we're here at the bottom of a long cycle, which, I mean, God knows what happens, but it looks to me as though we have touched a minimum in volatility in the markets. And once things get going, they get going quite quickly. So you see, if this and this are elements of what happens in the markets, then looking at this, it sounds as though we are about, just before the party starts again. Okay, there's a question about market depth level 2, which is outside of this webinar scope. So I think we're kind of done with the DWC thing. I appreciate this. There's a lot of things that take a bit of digestion in this one. That's why you can download the slides in the handout. You can also, this will be recorded as a webinar. So if you have any questions to whatever I say in the webinar, or you think I got something wrong, which might be the case, by the way, because this is being performed live, by all means, feel free to subscribe to our YouTube channel and ask the questions on the webinar there and there, and I will personally respond to each and every one of them. Okay, so if any questions is bugging you, I also in the next couple of weeks, we will publish in our blog our response to ESMA's proposal on limiting leverage and imposing negative balance protection on the CFD sector, and we will run very likely a webinar on it as well. So if you have any questions on the specific topic of DWC, I will write them now, and I'll be happy to answer them. In the meantime, we can go to the open Q&A session. And starting with Ali's question, if I can tell you a bit about market depth level 2. So, so level 1 and level 2, what you've got is what you see on market on MetaTrader is a single bid ask, which is giving you the bid ask at the top of book, which is the point where supply and demand interject. But what you don't know in MetaTrader 4 is the depth of the market, which is to say, okay, if instead of trading just say 10 lots at the top of book, if I wanted to trade say 100 lots, what would be my volume weighted average price, taking into account the slippage effect of wiping out market depth and going deep in the book. That's what the level 2 feed provides you with. We offer for users who are familiar with programming, fixed connectors, where we stream real time all the level 2 and level 3 market depth, so you can estimate the market impact of your trades before sending them. So I'm not sure, Ali, if that's what you were after, but that would be my first cut at answering the market depth level 2 question. Any more questions? So where do we stream it? So we stream it via Fix. And also, this is the other interesting piece of news, is we are in the final stages of, we've basically already purchased a MetaTrader 5 license, and MetaTrader 5, unlike MetaTrader 4, offers the option of streaming market depth. So the answer would be via Fix and or MetaTrader 5. Puchika's saying hello. So hello. How can I help? So Puchika's asking, I guess, how much, how to deposit in Darwinics. And basically, if you have any questions that are more to do with general stuff, feel free to email info@darwinx.com. And we have support in, I think it's 6 or 7 languages already. So we only advertise, so minimum deposit is $500 at the moment. So Alejandro is Alexander is asking, will we increase the Darwinian competition? Will there be more prizes in number? Is 48 the final number? So Alexander, the reason we started Darwinia was because we had to beat a chicken and egg, whereby in the beginning you don't have traders, you don't have good traders if you don't have investors, and you don't have investors if you don't have good traders. So we decided to be the first investor ourselves and invented the concept of Darwinia. Since we first invented that, it's been quite a bit of a success in both attracting good traders and also in attracting investor numbers. And there's upwards of 20 million of AUM in the system right now. So there's not such a big need to invest in increased Darwinia at the moment. We will going forward if we feel that it adds, but we feel that we have enough risk as it is, and also we don't want, and this is important, we don't want to crowd out third-party investors. If we invest too much, then third-party investors will think we've got a conflict of interest. So Alejandro is asking, can we use DWC as a correlation tool? That's one way to use it. Another way would be to purchase volatility. That's another way to, unlike the VIX, the DWC is tradable. And I think we're sort of done with questions, right? Okay, So Alexander is asking, the top 10 Darwins getting paid somehow? The top 10 Darwins are not getting paid somehow. They're getting paid investor success fees by being here. So you can work out, what the Darwins are paid, you can work out quite simply by saying, okay, you look at investor capital and you say the numbers are, okay, so THA, 3.2 million assets under management. You go into his return curve. Last year, 80%, assuming he had 3 million in the beginning of the year, which he did not. But if just to simplify, for this year's numbers, let's say he starts the year with 3.2 million. If he delivers 80% in 2018 and he collects 20% on 80%, that's 16% of 3.2 million, which means 500,000 of success fees. So that's what people are getting paid. And if you want to see what we've paid in terms of success fees via Darwinia, then you can go into the Hall of Fame. Where you'll see that the cumulative amount paid out to customers so far, since we first got this one going, it's been about $1 million, approaching 1 million now in success fees. And you can see how much each of them got. Okay. So Alexander is asking by, okay, I get it now. Apologies, Alexander. So that's the Darwinian Dividends, and that's going to be launched actually end of January, where you'll see it's the cash prices, which you see here, will be paid out to each of the top 10, and you can look that up. If you look out Darwinian Dividends in the blog, that explains how it's all distributed. Okay. Okay. And Ali is asking for access to that data, and the answer to that is fixed connector. You just ask for that at our support team, and they'll know how to guide you further. And also, we're going to this is not public yet, but there's a Darwin API and a search Darwinex on GitHub, and that's where you'll find ways to get the whole thing going. And if I didn't answer properly, Ali, by all means, you can email info@darwinex.com with the question, and it will escalate right through to me if people can't get it right. Okay. Well, thanks very much. Thank you for the attention. And any follow-up questions, as I said, this will be posted on the YouTube channel, and I will be very glad to answer those there and then. Fantastic, guys. Take care and speak soon. Oh, my name is Juan. Apologies, should have said that. This is the company CEO. All right, guys. Well, thanks a lot, and hopefully see you for the next one. It's likely going to be in a couple of weeks, so watch out. We haven't really programmed it yet, but we will shortly. Take care. Bye-bye.